Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London UK feed wheat. Paris milling wheat. After the market created a cusp back in late May, we had a resultant break higher. Something I'd cautioned about back then, and prices rose and fell through stratified layers of support and resistance. Some of them seemed then and still seem now quite dense, such as the congestion area of overhead resistance that we sit just underneath between 238 to 242, containing the March 2013 high at 240 and the medium moving average. Well, that's currently at 238. Just underneath we have the declining short medium moving average, currently at 235. The market pushed down through this 238 to 242 congestion in mid-November and dropped all the way down to the same lows we saw in May at 221 before reverting back up as part of this overall move. Now, as part of this overall move lower, I would like to again discuss some previously mentioned big picture items. Firstly, this market is still well within the big bear channel, currently 251 to well off the bottom of my daily chart, which is highlighted in dark blue on my daily chart, and originating from October 2022. That's well over a year ago. Secondly, I've studied the more recent action in greater depth over the past few weeks, especially since early September. I originally saw the opportunity for a possible sideways triangle, with the upper trend line highlighted in bright red, currently at 238, originally just above the medium moving average, currently 238 also, but now partnered with it. However, the original sideways triangle has changed its shape, though not its nature. It is still a triangle, but now a descending triangle, currently 233 to 238. In mid-November we had a break lower, and I laid out some targets below for such a pattern. Thus, a primary target was in the 227 zone, whilst the hardest to reach secondary target X1 is down in the 220 zone below, just under the May 2023 low. An even more recent study of this market revealed what I can only describe as a head and shoulders pattern in the wrong place. However, much like a cat's ears pattern is a version of a double top in a descending pattern in a descending market, this head and shoulders top is still there and also in a descending market, formed between June to November, with a neckline currently at 233 that has recently been entwined with the lower trend line of the descending triangle. Whilst I may not necessarily be comfortable with this head and shoulders pattern, I still feel obliged to indicate some potentials below for such a pattern. Thus, a primary target X2 is in the 215 zone, whereas a secondary harder to reach target X3 down below the bottom of my daily chart in the 197 zone. I'm not going to comment on these potentials any further at this time. However, this week, though we are close to last Friday's action, the action this week has set up an interesting new pattern. So we are set up right now for a weekly key reversal here. Hence, if we close tonight either over 231 or under 228, then we'll be on. Anything in between would have a lesser outside week. Right now we are looking on the verge of between an outside week and a key reversal down. It's right on the verge. London UK feed wheat. The move higher from the May to July double bottom pattern here reached its climax in mid to late July with a combination of an island top that was also part of a small double top, Adam and Eve type. Since then, prices have headed lower. The short medium moving average, currently at 186 even, has tried, not always successfully, to act as a sort of cap on any rises, and the medium moving average, currently 189.5, has moved from being a market attractor to being a cap to being now a more distant cap on any attempts higher. Interestingly, one of the key features here, and it is a surprising feature, has been the neckline, highlighted in dark blue on my daily chart, currently at 185.45. Of the May to June reverse head and shoulders bottom, acting as a pretty reasonable support until recently, though I suspect in the background the September 2021 low at 181.70 and perhaps more importantly the 50% absolute Fibonacci line at 180.5 have helped in the past to prop up prices. This situation is changing as the neckline is moving up and away from the September 2021 low, as well as the 50% absolute Fibonacci line, and they will begin to show their true worth as supports. On top of all this is coming in from above the declining long moving average, currently 189.60, dropping down to no doubt try and pressure prices lower. You can see the effect it had back in late July, capping the market with a small double top. It is not long now till the long moving average drops into the frame, so I would keep a close eye on it as the room for maneuver of this market is becoming quite restricted. So watch when it goes below the neckline, if it does, which may be as soon as the first week of January next year. In the bigger picture, there is currently no significant pattern development being undertaken, apart from the previously mentioned neckline, which I suppose is a little disappointing and unsurprising at the same time. In the meantime, the market has seemingly decided to curtail its slightly higher movement along and on top of the neckline, a sign, I suspect, of the impending greater bearish pressure that is coming from above. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.